Hi, and welcome to this short intro into how you can use the knowledge and information you already have to diagnose your business financial drivers and use them to make more profit, revenue, cash, and indeed time. I'm Kenneth from Centerpoint, your CFO and business advisor for this session, and I can tell you that I am pleased to have you. I want to take you through a simple review using 5 easy steps to perform a financial diagnostic and make your financial statements work for you. To do that, I will be using Mouse Virtual CFO Pro to turn your business into a goldmine. Step 1 is about obtaining assurance that your financial statements are fit for purpose to ensure you can rely on it and derive the right decisions, have no surprises, and have peace of mind. Step 2 is about reviewing your revenue and check its correlation to profit figures and margins, and drilling into it. And you want to take that and fusion it with having open and honest conversations with yourself about thoughts and actions you are undertaking and what's happening around you. What are the events that can cause the state of your financial drivers? Together, that will give you a better diagnostics. Step 4 is about turning the knob on your financial drivers. This is where we want to make an impact. We want to think big. We also want to be realistic, but think more big to unlock that cash, increase the profit, and build the revenue. And once you have that, you want to convert your financial diagnostic into KPIs and apply structure and accountability to improve profit, cash, and have fun times. It is easy. Let's do this. Let's have a look at Fred Flintstone's business. Firstly, we can prepare a management report from data we have retrieved from your accounting system. This report is your preliminary diagnostics, and let's have a look. Prepared this earlier for you as an example. So when the first bit we will see is the key drivers: your revenue, your income, your EBIT, which is the profit you make from your revenue, and your cash position, and your working capital. Revenue and EBIT, we will get more into the cash. This is really paramount that you have a strong cash position at all times, and it is doable. You want to do that so you do not spend time and energy on chasing cash. You want to spend your time and energy on generating revenue and profit and manage your business. And you know that. I know you do. And we can make it happen. It is definitely possible. The working capital is the money that you have tied up in your business from trading itself. So it's nothing to do with the money that you have invested in your business. It is simply the cash that you have tied up in your business by trading, and that be your debtors, the money you haven't collected, or the items you have placed on inventory. That is offset by your creditors. And what we have done here is we also want to include the tax position, the tax liability in there, because as you know, as you make profit, and you will also have to pay tax, and you need to put money aside for that. The good part here is that the longer you can delay the tax, the longer the taxman will actually be part of funding your business. So that is the good news. Okay, let's look at the report. So it's designed so it's easy on the eye to quickly give you a snapshot on how you are performing. The report in this case is comparing with last year. Why last year, I hear you say, isn't history is not a predictor of the future, and that is very true. But what it does help you with is, you know what happened last year, and you know what happened this year. So you have formulated an opinion in your mind, an expectation on how the numbers should look, even before you see the figures. And that is the key. The financials should really just be confirming what you already know, because you're running your business. So in this case where it's red, it tells us that we have gone down revenue-wise compared to last year. And if you look into the events during the year, or the environment you operated in, you can probably explain that. If you can't, then we have to look into it to understand it, so we can change whatever it is that causes that, so we can make our understanding work for us. The 40% up is a trend. In this case, the trend is comparing with last month. So we are improving, which is good. And other parts of it is the profit with the EBIT. What's interesting here is that we have increased by 40%, and truth to be told, the EBIT is only up by 1%, which is an absolutely no-no. There is definitely something wrong here. We spoke about the working capital before. That is pretty much these items here. Expenses. I want to just dwell on this a little bit. This is typically an area of your business where, in my experience, that you can very easy, pick up very low-hanging fruits to improve your profit in your business instantly. Just by raking through your expenses. That could be simple things, and you would already know this, like your phone bill. You might have set that up at a time where the plan was good for you, but now your circumstances has changed. The competition is so that the offerings are a lot better, so you need to change and therefore save money. It could be that you had a marketing campaign in the past, and there you signed up for some marketing material that you are still receiving and paying for, and you did it by direct debit, so it just goes out of your bank account. You see it every month, but you do nothing about it because you're too busy. And there will be lots of little things like this, and we will just apply a session where we go through all this and fix it once and for all. And we'll do that, or you will do that maybe once a year or twice a year, or indeed, better yet, as you go about your day and running your business, you will make those actions, or you will have people to assist you in doing so. As I said, in my experience, really an area where you can pick up a lot of money very easy, and you will benefit from it month after month without any effort whatsoever. The other part of the report is, for instance, seasonality is very important, especially when you want to plan for your cash flow, your budget, and your forecasting, etc. This shows you pretty much a seasonality on your revenue, which you would understand intrinsically. Here we see the 40% increase, and that could very well be just due to the seasonality. But what we don't like is that the EBIT has only gone up by 1%. It should really go up by maybe not 40, but close to it. So we still haven't got an answer to this. Why is it the revenue has gone up, but our EBIT not? Break-even point. This is really, really important to understand your break-even point. Why? Well, because by understanding your cost structure, you will always be in a good position to, when you do your coaching for new jobs, you will understand when we go through this how how much of your cost is fixed and you can't touch. It doesn't have anything to do with your revenue. And then there will be cost that will go up when you do sale, and that is perfectly fine. We just have to make sure that the gross profit on that is perfect. And when we understand those things, we are able to run a very good business. When we go through it a bit more and check it out, you'll see what we have done in a graphical form, showing here that you have an excellent position for your revenue growth. Your profit, yes, it's up, but it's only good. It should really be excellent, and we will make that happen. We just have to find out where the issue is. We check further through here. We can see the 40%. This is flat. And here we go. Here's the reason. We see the revenue growth, and the gross profit margin should be flat. But in this case, it's gone down. So it tells us there's something wrong with the cost of the goods that we are selling when we generate our revenue. Now, why do I say that? A simple example would be, say you have an item, you buy it for $10 and you sell it for $20. Your gross profit margin would therefore be 50%. Therefore, when you sell 2 items, the gross profit margin will still be 50%. So when your revenue growth is 40%, you do not expect your gross profit margin to go down like that. You want it to be flat. So there's an issue there, and let's look into that. So what we'll do, we'll go to the financial health data. It's pretty much the underlying data, and that is an easy way to check it out. And we can see here how the gross profit was unchanged, as we saw on the initial financial diagnostic. And it shouldn't be the case when the revenue has increased by 300, as we can see here. The cost has gone up by the same amount. So I think we should have a chat with Fred about this. And by talking to Fred, we discover that he has his activities he has bought more inventory to be able to be prepared for the festive season, where he will need a lot of goods to be sold. So he has bought for about 100,000, and what he has done is he normally has his bookkeeper to just push supply invoices straight to the cost of goods sold for simplicity, because that's where it ends up in any event. And yes, that is simple. And yes, if you have a business that is not subject to seasonality, that is fine. In this case, where we have seasonality such as Christmas season, where you would sell more and you have to prepare and buy in time for that ahead of time, so there'll be a time delay on your sale, then it's better to not be so simple about it. And again, what we found is that this 100,000 should actually have been recorded as inventory. Therefore, this one should have been reduced by 700. So let's go away and correct that. And this is where the first step, where we talked about the insurance for the accounts, is important, as to not to be bogged down into whether the accounts are right or wrong, but also to have that peace of mind that we can trust the numbers. And you can put in processes to make that happen. Let's just correct this as we go. Normally you would then push that through the accounts again, but we're sitting with Fred. We're sitting with you now, and we want to reach a conclusion which is a sound. So we will just quickly correct it ourselves. Okay. Alrighty. So I will now go ahead and just do that. You should be a little careful if you were to do this yourself. You should know what you're doing, which is fine. If you do, we just want to quickly change what we believe. You can see here the 300,000 did not reflect the extra purchase of inventory. So we are now putting that in, and that is all good. Now let's check out what that meant. We'll check out the ratios. As you can see, I have to pick the right one. We'll see that's now gone up to 200,000. It was only 100 before, so that is now cool. Quickly show you what it looked like before we made the change with regard to the gross profit margin. You see it was 24%, 33, 50, and 33. And we couldn't understand that. And now what you see is 33, 33, 33. What you also see, which is interesting, the 50% there, that tells us that our business could actually be a lot better than it is currently performing. So let's remember that one. And we now know the accounts are in good shape, and we will move on to see what we can do to improve the business. Now we talked about improving the cash, unlock the cash. So we will go away and do that now. We have our debtor days, which is 35. Traditionally, you would say it takes about 7 days to process an invoice for an organization. So that is probably your best target, unless, of course, it's a cash sale. Many have negotiated 30 days. As I said, you want less than that. But we could argue that we could reduce it here. So it's a matter of just turning the dial. Let's bring it to 20, which will unlock 40,000 just by asking for the money quicker, or have our terms and conditions to be so, and follow up in good time. Best way is really that the customers will pay on delivery. If you wait too long, it's harder for them to pay because they don't see the value. So you want to collect it as quickly as you can. The older it gets, the less likely it is that you will get the money. When we talk about the creditors, this is really where we want a high number to fund our business, but we also want to honor due dates. I will keep your business. It will keep your business healthy and in a strong position to negotiate. So what you want to do here is pay on the due date, negotiate a long-term credit. So we want to increase this. We want to be able to do that. As we said, conversely here, it can be acceptable if you are a strong, reputable client of theirs, customer, that you should be able to do that. So let's say we can reach it at 30. The other thing is you want actually this to be higher than that. Why? Because that way you are always will have a positive cash flow. Well, with the one qualification that depending on the margin, but that's a detail. But if you have this ratio where you have your credit days higher than your debtor days, well, you're doing a good job then. we talked about the inventory, and we saw before how it had increased by 100,000, and that's what we see with the 400. We normally see 300. So in this case, we could say, yes, we have tied money up in inventory here. And again, that's why you want really to focus on these, so you have the best cash possible. So you have that financial freedom. So what we can do here is, we know for a fact that we will sell this. So we can reduce this safely to 300,000. What it means is that we are not going to spend any cash buying the items to sell what we are going to sell. Therefore, whatever we sell will go cash straight into the bank account. And that's where we want it to sit. Okay, so I've done that. We have now unlocked $153,000, which is not bad. So we'll save that one. And now let's talk about the revenue. And this is where we can really think about what we can do to improve this. So we had a million, as we saw before. We really want to do that. And there's a lot of components we can do that on. We have the leads. This is the prospects that you have in the market, and your ability to convert them into customers. And then you have your average sale. And this is where upsell comes into the picture. The better you are at that, the better the average value sale will be. And then the number of times that each customer buy. So let's see if we can push this up. Let's not be too aggressive. Let's say we can generate 5% more leads, and our conversion rate, we will be able to increase that by 5. And already we are unlocking sales of 107,000. And that is not too bad, I don't think. I think we can also increase the average sale a little bit. So let's improve that, shall we? Hey, that's cool. So now we have 1.2 million. And you will say, oh, that's easy to dial the button there. Yes, and it is. But there's so many ways where you can increase this. Actually, here I could recommend you sign up for the mini MBA. It has takes you through business administration, and all of this is covered in there, and how you can massively improve your probability of achieving this. You will succeed if you apply the system. You could be your own coach almost. So the last one, of course, is the profit builder. And what we will see here is we need to unlock. We needed the profit to be increased to what did we say? 1215. So we will do that. So we'll put that one in. Okay. Now, at the same time, we know we were able to get to 50% profit margin, but let's not be too aggressive. Okay, that's better. And so we want this to be maybe not half, like the 50% suggested, but at least we want to improve it by, let's say, 658. That is possible. We know that now. We wanted more leads, so we do want to put more marketing dollars in the game to assist us in doing that. Now, you would have a whole set of marketing strategy to achieve this. Again, the mini MBA could be an assistance for you to achieve that. We'll leave the others as is. We'll leave that for another time. Now, that left us with 211,000 more in profit. And as we know, profit will eventually become cash if we manage it correctly. Okay, so all this. So all this, all in all, we have we unlocked cash of 154,000. We generated more revenue of 165,000, and in turn that meant that we were able to increase our profit in total by 211,000. And you would say that's easy on paper, and yes, it is, but it's also easy in real life. I know this. It frustrates me to learn how many businesses could be driving a far more profitable and enjoyable business, but don't have access to the right systems and knowledge. The one guarantee I make to any business is that I have access to the best software tools, systems, process in the marketplace, and together we will make a great team. So what have we discovered? We've discovered that you need to have your financial assured to have your financials to tell the story, to know how and what changes to make to your drivers to increase profit, unlock cash, and build revenue, and understand the power of perpetual profit savings and one-offs. So have your accounts certified to be assured they are fit for business analysis and to be meaningful and assist us to make the right decisions and ask ourselves the right questions. You want internal controls and automated processes to prevent errors with no extra efforts. This is where you want a chartered accountant, such as myself, to give you that assurance. Your financials tells the story. So it's about you reflecting on your business and the environment you are operating in. You want to focus on the key figures and compare them with what you expect and understand the drivers and how they impact on each other. Focus on your key figures for your initial financial diagnostics. Think and reflect on what they tell you and how they correlate to each other and what impact they should have on your business. You will find this is a powerful tool that you have tailored for your business. For example, revenue is growth, GP percentage is your contribution to your bank account, disregarding your fixed costs. Your net profitability, or EBIT as it's also called, that EBIT percentage shows your business viability in simple terms. Note that well managed, this will all equal into cash. And conversely, if not managed, your profit will turn into losses. Another point to note is the components on how to generate more revenue, how to unlock the cash, and what part of your expenses you can influence to make a better profit. So you want to visualize your business and how it should perform. And then by using the virtual CFO, you can turn and dial them up to make it so. And you can see how it is. And then you'll put the changes in place to make it happen. Another point to note is the difference between perpetual profit savings and one-offs. The perpetual is saving put in place that will generate week after week, year after year, more profit, such as an improved gross profit percentage or a revenue increase by method of lead conversions. This is also how you multiply the value of your business with very little effort. And one-offs are the likes of improved debtor payment days. It will give you cash here and now, but only once, and also you will need to maintain this. That's a little bit about myself and Centerpon. And if you like what you saw, feel free to contact us and sign up via the web page. Think big, think simple. Thank you very much for listening. Talk soon.